guys. So excited to be here today with Carlos Domingo from Securitize. He's a wonderful person, and he's been a thoughtful leader in the space of security tokens. Carlos has come to us from working, I think, about 3 or 4 years now at Securitize, one of the most successful companies in the space. Before that, he was at Telefonica, and he also launched Spice VC. So he's not only a well-respected technologist at telco companies, but he's also kind of an OG now in this space. So welcome, Carlos.
Thank you, John. It's a pleasure for me to be with you. We've known each other for a few years already. You're also kind of an OG of the space as well, with your background prior to being the president of AVA Labs as the CEO of digital assets for SharesPost, where we first met and started working together. And for the ones that don't know John has a very vast experience as a technology investor at major funds like Tiger and Kingdom. He runs his own fund and he's doing many other things. And I just learned he also plays golf.
Cool. Well, it's a lot of fun being here and talking to you about security tokens and in general, how institutions and finance are now moving into, I guess, crypto and DeFi and security tokens. I know when I started as CEO of Digital Assets Group at SharesPost, trying to tokenize assets, private shares, whether it be at that time was Airbnb or funds, the technology was very clunky and the regulatory regime was actually not clear. People like you guys have helped streamline that whole process on both the tech as well as the regulatory regime. My mission at the time was actually to basically bring the services and products that I had as an institutional investor to every individual investor. As an institutional investor at big and large funds, I had access to private assets. I had things all over the world. And then when I tried to invest in these things like Lyft, Airbnb, when they were still private, personally, it was actually very, very hard. And I went down that rabbit hole to try to make that easier for the individual to invest through the security token manner, just as you guys did, to bring it to everyone. I also learned that it was very tough to do. And I think that there's 2 channels now to fulfill my goal, not just in security tokens, but what DeFi is doing also is very interesting because it's now bringing services and products, literally things like savings, loans, and other derivative and synthetic type products that people have in the institutional space. And now they're making it available on a global basis, as well as for the smaller individual investors. So I'm very excited about the time right now we're in on the blockchain space. I mean, Carlos, feel free to give me your experience.
I think that, we've all experimented the same thing, right? That, when I started in this business in 2017, there was so much hype around security tokens and people, I'm not going to mention who, were saying tokenize everything and everything is going to be security tokens on the blockchain, every single asset, blah, blah, blah. And I think that everybody, including probably ourselves, underestimated 2 things, right? First, the technology, as you mentioned, was very clunky and, it was not ready. And the user experience of getting connected to a blockchain or issuing things there was not there. And there was a lot of other non-blockchain infrastructure required, like, a very streamlined investor onboarding experience and trading venues, et cetera. But I think the other thing you mentioned is the other interesting thing is that from a regulatory perspective, a lot of the bits and pieces that you require were not there, right? So we didn't have qualified custodians back then. We didn't have transfer agents that were approved to operate on the blockchain like now we are. You guys were the first ATS that was approved for digital assets, but it was just you, and then open finance came, and for the most part that's it, right? So the other people that have ATSs either don't use blockchain or they haven't gone live yet, and I think those things hinder the adoption, and then people kind of lost interest. And on the other hand, now we are in a much better situation because all these things are in business. We have tons of different qualified custodians, whether it's Coinbase or Anchorage. We have transfer agents that operate in the blockchain like us and others. We have many ATSs that are coming live. Our own one, Securitize Markets, that we purchased at the end of last year, but other companies like North Capital or Rialto, etc. And then from a regulatory perspective, I feel that the last few months of 2020, we made more progress than the last 3 years, right? Because in 2019, you might remember that there was this joint guidance from the SEC and FINRA basically saying if you're a broker-dealer and ATS operating with digital asset securities, which is the terminology they use for security tokens, you cannot do anything. That was pretty much like a summary of what that said. And it was very frustrating. The last few months, they issued a number of no action letters. basically giving a lot more flexibility and freedom to operate on this space, which I think is going to make a big difference, especially in the US.
The other thing I found, besides a regulatory regime changing, or you guys basically getting the licenses, you have a transfer license and some other things that have led the way and taught people how to do this appropriately, was that there was really adverse selection in the people who actually wanted to issue a security token at the time. So I set the system up, basically killed an inordinate amount of brain cells working with the SEC and doing a change of membership agreement of an ATS. And then all of a sudden it's like, okay, who's coming to me to launch? And it really was companies at the time, especially 17, 18. If you were a good startup company, you can just walk down Sand Hill Road, open a door and raise money. Why would you want to do it in a security token manner? So we had adverse selection of companies coming to us. What I'm seeing now, why I'm excited for, is the higher quality inventory is actually coming, and you guys see everything. So hoping you can share some sort of different areas or buckets that you're seeing that makes this even more interesting.
You're absolutely right. I think that the industry started with the wrong approach, right? It was kind of like, when all the ICOs were at the hype, and then, the SEC in 2017 issued the famous DAO report that basically said ICOs are sales of unregistered securities. If you do an ICO, this is illegal. And then there was a lot of like bad projects trying to do an ICO that they say, oh, we'll do the bad project, but as an STO. And a lot of people thought that because I call it a security token, I'm going to raise money from crypto people that are going to throw money at the problem, because the crypto at that time in 2017 was like booming, right? And we definitely got this problem. I think that the crowdfunding industry kind of went through the same journey when it started in 2014, 2015, that at the beginning companies approaching crowdfunding were the companies that didn't have the ability to raise money from VCs. And I think the same way the crowdfunding industry matured and it just became another tool for people that prefer to raise from their customer base, I think that we're seeing two different things in the security token space. One is this type of companies that want to basically raise from their user base, because they see it as a way to basically create really faithful long-term fans from their own user base, because they've invested a small amount of money in the company and equity in the company, which is kind of like a little bit the concept of the ICO as well, of you own a part of the company and then you cheer for their success, right? But we also see like more institutional grade projects that are coming online, that they just look for digitization, right? They want to have a platform where they can actually get an end-to-end digital process with fast asset servicing, fast clearing and settlement for trades, and things like that, which are problematic using, in private capital markets, because everything is manually done and everything is slow. So we're definitely seeing the change. I think 2020 was probably the inflection point in terms of, better regulatory clarity, more, people coming into the space, and then, increased quality of the projects.
And on the technology side, I thought things were very clunky. For any issuer who wanted to do a security token back then, they had to go to 4 or 5 different service providers, patch it up together. And then they, as you said, on the regulatory side, there was a lot of still uncertainty. That's part of the reason why I thought, coming to AVA Labs, I'm president of AVA Labs now, we consider ourselves the next generation of blockchain, where we have speed, 5,000 TPSs, and we have, low latency, finality in less than a second. But what's interesting, I thought most for coming into a platform like ours, is we were built with the eye towards creating features and enabling whoever it was, whether it's a DeFi person or a regular enterprise who wants to issue tokens in a very easy manner. I mean, the example I have is like in the early 2000s, if you were a offline store and you wanted to create an e-commerce web experience, you hired a consulting firm. They came in, you spent hundreds of thousands of dollars, and a whole bunch of people came in and took a long time. And then you got this clunky website. Today, you just literally go to Wix and put in Shopify, and you can click and drag and you instantly have that. That's what Avalanche is trying to make it easy for enterprises in order to launch their own platforms for issuance. But they need help from guys like you, people who actually have the transfer agent, have the ability to get them, shepherd them into the right custody. But the benefit after that is they get to tap into a larger community And, we have a great community where our investors would love and our people in the community would love to see other types of assets than just the traditional crypto type assets. Um, I don't know if you're seeing similar things in the companies that are coming to you.
So we definitely, saw the problem of at the beginning, if you wanted to conduct security token offering, the companies that were out there like us or others didn't have like the whole solution, right? And I think what you were saying kind of has two pieces, if you allow me to break them down. One is the off-chain pieces, and the other one is the blockchain itself, right? So
Right.
on the off-chain pieces, you're right. We always had from day one the mentality of we want to offer an end-to-end platform that people come and get everything done and don't have to worry about anything, because the business of these issuers is not to issue securities, it's to run their business or to sell the securities or to trade them, but not to manage the process, right? That's something that somebody should take care of, and they shouldn't have to think about it. But there was a lot of companies in the space that have different views, that they only had like a protocol tool where you could issue the token on the blockchain, and then you have to figure out how am I going to use for KYC, or what am I going to do for the dividend payouts or things like that. And so we always had this vision of like the platform has to be an end-to-end platform that allows for the entire life cycle of the process, from investor onboarding, if you're making an offering, how you're going to sign purchase agreements, review the documents, register wallets, individual from custodians, issue the tokens, and then manage the entire life cycle of the security. And I think that we didn't have that in 2018 when we started. I think we definitely have this now on top of the regulatory coverage that we can provide for issues. Now, the other piece is that we, as everybody, started on Ethereum. And then, when the industry was still in its infancy, Ethereum was working well. And now that the industry is kind of booming, Ethereum is broken. And then, at least we have companies like Avalanche that are bringing, blockchains that will be able to scale for these transactions. I'll just give you one example without mentioning the customer but we're talking together about with them, is that these guys are onboarding thousands of investors in our platform, thousands and thousands and thousands. It's going to be by far the largest security token ever done in terms of the number of investors. Now, initially they wanted to do it on Ethereum, and we were telling them like, do you understand the cost that it's going to have? It's like, well, sure, yeah, a few $100,000 we'll pay for it. And I was like, no, it's not going to be a few $100,000, because if you have, let's say, 50,000 investors, every time you register a wallet and issue the token to each investor is going to cost you, at the current gas price, first, you don't know how much because it changes every day, but it could be like $50 or $100. So do the math. This is not going to cost you hundreds of thousands of dollars. It's going to cost you millions of dollars. And then I think the speed is critical when we get volume for trading and stuff like that. But today, I think the main friction point is the cost of transacting with Ethereum. And I think this is where companies like you come into play to be able to provide a very good, robust, decentralized blockchain experience that functions much better, lower cost and higher transaction rate. And this is why we're very excited about, the partnership we have with the two companies, because we can now tell customers, don't issue on Ethereum, issue here. This is going to work. We have also some degree of Ethereum compatibility, which makes it easier for us to migrate and then support, the rest of the ecosystem, wallets, blockchain explorers, all the stuff that you need.
That's a great point. I mean, we've done some studies where Avalanche is basically 10 to 20 times cheaper, depending on the time of the day or whether it's at peak or not. And that's a great point, because a lot of people think just because you're not financing crypto and then you don't need that exchange high throughput, that it's not as important. But in your example, and just to play a little devil's advocate, is that just an extraordinary one-time case, or do you see more and more situations like that going forward?
We see more because, look, the Reg A plus crowdfunding exemption has just lifted from $50 million to $75 million. And I think that any company that is a consumer-facing company that has a lot of users, and the most famous case that was a few years ago is a beer company called BrewDog, which people in the crowdfunding industry know very well. That beer is a beer company that has a website that you can buy beer online, and it's kind of like this boutique type beers. And those guys conducted a Reg A plus successfully, just selling to their base of consumers of the beer, and they conducted successfully. And I think that this is a very good way for companies to raise money from their own base, because it's not the value. So if you raise money from VCs, they bring a different type of value add, right? So they'll help you with contacts and advice and stuff like that. But if you raise money from your own base, what you're doing is you're creating customers for life, because obviously that customer, is not going to go and start working or consuming a competing product if they have equity in your company. So I don't see this as a one-off. I see this as an important one. And I think that I was focusing very much on the cost, because that today is where the pain is. But I think the speed will become more important as these projects become live and then they start trading. Because if you raise money from 20,000 investors as a private security, as a Reg A Plus, that is a private security, but has a lot of freedom to trade it, even with retail, that's going to trade almost like a mini IPO, right? And that's going to probably have enough transactions. And the view is that those transactions should settle, every single transaction should settle on the blockchain every time, because that's the beauty of the blockchain, where you can do atomic swaps between the cash on chain and the security and settle instantly, no counterparty risk, no, centralized clearing issues like Robinhood had with GME, a few weeks ago. That we can talk in more detail if you want. So that's the view, right? But for that, you need a blockchain that, works well, is decentralized, but at the same time is affordable in a per transaction basis and is fast. So, and I think that today Ethereum has somehow become like this settlement layer for very big transactions, and it's not something that works for people that want to run many transactions with that have small monetary value.
That's a great point, actually. And I don't think the general audience realizes that since, when I was trying to create an exchange for security tokens, the number and the dollar amount that people can raise in a regulated crowdfund manner like Reg A plus has changed. Can you, and CF as well, can you remind the audience where that was and where it's gone to?
Yeah, so in 2014, the Jobs Act passed, and this is where the crowdfunding industry kind of started in the US. And the main idea was the following, which I still think that the regulators really support this idea. You were saying that, when you run a fund, you had access to all these great private investments, right? That, individuals, even if individuals are accredited, individuals literally have no access to it. So if you think about companies that are going public now, like Airbnb or Palantir, like these companies are 15, 16 years old when they go public, and they go public at $100 billion, like, PayPal or Amazon, these companies went public at, low single-digit $1 billion. So most of the money used to be made on the public markets, which is accessible to any investor, retail included. And now it's the opposite. The value has shifted to private capital markets. So I think the SEC obviously has access to all the data. So they saw that coming. And then they created this Jobs Act, which is called Jumpstart Our Own Business Act, to basically allow businesses to raise money more efficiently from retail and accredited investors. And they did a number of exemptions, right, depending on what you wanted to do. And the two main ones are Reg CF, regulation crowdfunding, which used to allow you to raise $1 million. And it was raised to 5 million recently, because 1 million obviously is a very, very small amount of money for most companies, especially in the US, with the cost of people here and everything. It's too small. So the SEC has corrected that. The second one is Reg A Plus, which was being presented. A lot of people refer to it as a mini IPO, because you could raise up to $50 million. A lot of companies on the IPOs, mid-cap companies, raise 100, 150. Now it has lifted to 75, which is even better, right? Now, the missing piece for these mini IPOs is the liquidity, because on an IPO, you not only raise money, but you provide liquidity to investors, because you basically raise the money and list the shares. I think with the combination we have now, blockchain-based securities, Reg A Plus, mini IPOs, and then on top of that, regulated ATSs that can actually trade those securities from the Reg A Plus the day after, we've really done the mini IPO thing on the blockchain. So it's great. So I think this is kind of like the next, financial services infrastructure that is being created as an alternative to the existing one. And right now, trying to go and fix that one, we're kind of creating parallel rails that more and more people will come. And as the regulators feel more comfortable, I believe they will start lifting the restrictions there, and it will become the new way people, consume financial services.
What are the trading restrictions of a Reg A plus or a Reg CF? Is there a 1-year period or
Nothing?
nothing? Right
Nothing.
away, you can start.
Right away. So the main problem with private securities are two. One is that you have trading restrictions, like you have to wait for a year, or and then the second one is that there is a limit in the amount of shareholders you can have. That basically inhibits liquidity. So in the US, if you're an operating business, and then you have more than 2,000 shareholders at any time, then you have to become a reporting company with SEC, which means you have to do a lot of filings, which are going to cost you like $200,000 or $300,000 per year. So most private companies want to avoid that. You also have to publicly disclose all your numbers and things like that. With a Reg A Plus, first, you don't have those limits. Those limits don't apply. You can do retail and accredited investors, and you can trade right away, really freely. So this is truly like almost like the closest thing to going public that you can have today at a fraction of the cost, because an IPO is very expensive, with a fraction of the fees of all the intermediaries involved in an IPO. And then you can, on top of that, if you could, you can actually raise the money directly from your base, not having to actually go to an investment bank to broker the raise and take 5%, 8%, whatever they take.
So you mentioned how the exchanges now with ATSs they're going to provide the second bottleneck to these crowdfunded raises, which is providing liquidity. I've had my shares of IPOs as a professional investor in the past, and part of what the banks do to help out with the IPOs is effectively, in a weird way, they're marketing the company, taking it around to large institutional investors. Goldman will take XYZ company, spend 3 months introducing them to the large Boston contingent of mutual funds, and then the ones in Maryland, DC, Virginia area, and then take them all to California, all over the place in New York, where all the hedge funds are. And then effectively teach them what the company is, and then create demand from that process. Who and how is that done in a Reg A plus manner?
So that's a very good point. So there's two ways to do it, right? So there is one way is you go to, I don't know, Republic or Citiinvest or somebody that already has a base of investors that are interested in this type of deals, and then you conducted it through them. And then you have access to those investors, which is kind of like the equivalent of the investors that JP Morgan has access to, right? And obviously it's a very different crowd and different type of people, because there's a lot more retail, etc. But those companies have hundreds and hundreds of thousands of investors in their databases that they market those deals. The other one, which is the one that I think is most interesting, is you market it. Maybe you get help of someone like Issuance, some of these companies that help you with the marketing materials and stuff like that, but you market it to your base. So if you're a consumer company that has hundreds of thousands of users or millions of users, those are the guys that you want as investors, right? Because keep in mind, these are not billions of dollar raises where you need institutional investors. These are dozens of millions of dollars, let's say 50 or 60 or 70. So you can actually raise successfully just from small, from aggregating a lot of the small tickets, a few $1,000s per ticket, which otherwise would be impossible for a bigger offer. So I think that's the way it's happening. Now, the second part, which the investment banks do, as you know, is they keep a floor on the shares, right? Like they make sure that it doesn't drop dramatically every day, even though like now, I don't know if you saw Oscar Health when did an IPO and it dropped 10% or 15% the first few days. And it was not the best week to go IPO this week if you've been following the markets, but nevertheless, sometimes those things happen, right? So, but the investment banks also do market making, and they make sure that the price stays at whatever they decided to list it, etc. I think that second part is still not there. I think ATSs need to launch first, and then after that, the kind of market making for these ATSs will come. And then another interesting thing is that potentially we're looking at, why not do automated market making like happens on DeFi, right? That's a super, super interesting thing. And I'd like to hear why your plans are on DeFi, because that's something we've been looking at very carefully, thinking like, well, this is great, right? Like private securities by definition are less liquid than public ones, but this is a way for automating market making and creating a market, that for sure you'll be able to sell your securities, because the number of investors that have pulled, their existing securities or cash in a place that there is an algorithm that, always gives you a price and trades out of the pool.
So before we get to that part, and introducing these securities to a different type of audience, back in the traditional world, after the Reg A plus raise, and then it's trading on these ATS type of exchanges, is it that asset, can it actually graduate to trade on a New York Stock Exchange as well, or how does that work?
Yeah, sure. So you can do you can do a Reg A plus, and then you can raise up to 75. By the way, you can raise 75 million every year. So it's not that when you do a Reg A plus and you can't do another one, you can do, as many as you want, as far as you can raise more than 75 million per year. So I think that if you wanted to then graduate and then go into a big exchange that obviously is going to have more liquidity, etc., you need to file on what is called an S1 with the SEC, needs to be approved, and then you need to go and talk to NASDAQ or New York Stock Exchange, whatever you want to list, and convince them that they let you list and pay their fees, and then you basically take all the stock of the company, but some of them will be from the Reg A Plus offerings, some of them will be preferred shares. If you had also VC investments, some of them will be common stock from employees or founders, and then everything gets converted into one class of shares, which is common stock, at least the ones that trade. And then you list there and trade, and you can do a direct listing these days, which you don't have to actually raise money or pay fees to investment banks. So
interesting. Now, if you want to do a global raise, obviously in the US, you have to abide by the rules of Reg A Plus or CF. How do you raise that while you also do a global raise around the world? Because there's different regulations all over the place.
That's another difficulty that we've been facing, right? So the promise of security tokens is that these are global, securities issue on a global distributed ledger like platform like Avalanche, that theoretically it should eliminate the barriers and the boundaries between countries and investors, right? That's kind of the view, right? And the vision. Today, obviously, the main friction there is that regulations in each country are different. So as a company, one of the things we've been doing is kind of like going country by country, well, the major ones, and we have more than 50, and working with local law firms to understand what are the equivalents of the Reg A Plus of the world in other geographies, or what are the restrictions to sell and register securities to investors, etc., and kind of try to use software to code those restrictions to be able to then onboard multiple investors. On a Reg A Plus offering, actually, you can sell Reg A Plus to, let's say, investors in other geographies. You just have to put disclosures and follow some of the regulations of those countries, but you can do it as a single offering. And some of Reg A Plus have successfully raised from multiple geographies. The legal work gets a bit more complicated than if you do it only for US investors, but it's definitely doable. Now, the other alternative is you do a Reg A Plus for US investor and a Reg S, which is the other exemption for selling for non-US out of the US. And then the complexity there, as I mentioned, is to figure out the different regulations and restrictions per country on from the investors you're onboarding into your offering.
But those are not fungible securities, though.
Exactly, that's the problem. So there's something called flowback that will then create two classes of shares. So the Reg S shares kind of flow back into a Reg A Plus or into a Reg D if you do Reg D. So you'll have to keep those things separated and trade separated. But I think that even if they're separated first, because all these exchanges that are coming online like ours are digital, right? It's very simple to show, people, the order book only of the things they can actually buy or not, because you can segregate very quickly. And then second, it helps with price discovery, right? Because you can show them what is trading, even though those orders, some of them might be from the parallel class, because the two shares represent the same, right? They represent the same equity in the company. It's just from a regulatory perspective, they're not fungible, but they're identical from all purposes, right? So that helps with price discovery, even if it hinders liquidity a little bit.
I mean, the funny thing is that's actually the same problem has existed in the past. I mean, a little bit before our time, but in the 90s, if you wanted to invest in equities in I don't know, Southeast Asia, or Thailand, or Singapore, there was A shares and B shares, or onshore or offshore. And foreigners who wanted to invest in Thailand didn't have access to the 100% of the outstanding shares. They only had access to X% of the outstanding shares. So when there was a hot market or a hot company in that area, in Thailand, or the Thai exchange or something, invariably the offshore stock actually traded at a premium to the onshore one, which is the local one. And it'll be interesting when liquidity is really great in the security token space, and to see if those dynamics repeat itself going forward. But it's great companies like yours that have actually even made it possible to get to this point and be able to separate the, call it A and B share tranches.
Yeah, look, I mean, this is the beauty of the blockchain, right? So that you can digitize and automate, those processes of enforcing compliance and things like that. And this is why I really believe that this is the future. The way people will trade is with digital asset securities on a blockchain, because it makes it very easy to segregate different class of shares, or enforce different restrictions, or enforce flowback restrictions, which is called between this class of share to the other one, and things like that. And then not only that, but it also becomes open, right? Like if suppose we issue all these tokens on Avalanche, and we are the transfer agent, we issue the securities, and we can have our own ATS trading, but another ATS can inherit the same properties and the same functionality. out of the box without having to create their own like software or integration or anything, because everybody shares the same ledger where you have, the securities and cash as well, which is very important because then that helps settle the trade very quickly. So
That's
that's
right.
why I'm excited about this technology.
Yeah, that's great. So, my mission, as I said earlier, when I came into running these companies, was to basically open up finance, bring the services, products, and the assets to all the individuals. Security token was one matter. You also brought up DeFi and what we're doing in DeFi and what you will be doing in DeFi. So what it's really exciting to me about decentralized finance is that suddenly we had this ecosystem of loans, derivative products, all of these things that exist in the traditional finance world, but it's done in a decentralized manner where you cut out, literally, it's like ripping out the infrastructure and allowing these companies to, or people to actually do it in a P2P manner, creating liquidity that is just startling at some point. I mean, if you look at things like Uniswap, it's amazing that we're talking about Coinbase right now, IPOing. And sure, they are a fantastic company. Last private round was about 100 billion. They've been around for like, I think close to 10 years now, if
9 years or something.
9 years, and fantastic volume. But if you look at Uniswap, it's been around for maybe a year and a half, but Coinbase has like thousands of people, like 3,000 people working there, if not more. And Uniswap has at most like 20, 30 people. It's been around a year and a half. And there was a point last year when I was comparing the volume on a daily basis, the volume on Coinbase was similar to that of Uniswap, which is absolutely incredible. And based on the network market cap of their token, it was like at that point it was similar to Coinbase, not right now, but which is fascinating in a whole different light of what DeFi has shown traditional finance, what possibilities are out there. Now, frankly, I think DeFi is fantastic and I think it's here to stay, but it's also a petri dish of experimentation and fraud, as well as all the good things we just talked about. And in terms of how it helps securities, a traditional security, and make it regulatorily compliant, if you will, that I think people are still thinking about. And you guys being the thought leaders in this, have you guys thought about how to do that?
Yeah, we thought, a lot, and we actually wrote a number of like, pieces of what we refer to as hi-fi, which is like hybrid finance, and instead of decentralized and instead of centralized. So I think you have Coinbase, which is fully centralized, and you have Uniswap here, right? But obviously there's a reason why Coinbase has 3,000 people and Uniswap 20, right? It's because Uniswap doesn't do any compliance whatsoever. They don't know who the investors are. They don't onboard investors. There's no customer support, so it's not comparable, right, to the business. And I believe that at some point in time, this fully, completely anonymous way of trading, etc., is going to get into the eyes of the regulators, and kind of we move liberally there. But there is a middle ground where you can still, that's our view, you can benefit from these great inventions like automated market making or lending protocols and stuff like that, but providing a little bit of a regulatory coverage. So what happens there is a bit more control. At least you know who you are. Because certainly for securities, you can't just trade a security anonymously on the internet, right? That's illegal. So you need to know who holds the securities, because these are regulated instruments, etc. But you can think of, and we've done a lot of experimentation with integrations with Uniswap and Balancer and Compound, and the beauty is it works very easily because they are all compatible with the same infrastructure and protocols. But you need to add a few things, right? Like one of the first things is you need to obviously have the wallets that interact with these protocols have to be associated to an investor account. We have a product called Securitize ID that facilitates that we as a transfer agent more than investor do KYC and accreditation once, and once it's done, you can register a wallet, and then that wallet becomes a wallet that is known to whom it belongs, and then we can allow it to trade, let's say, in a decentralized manner using Uniswap if you want, right? So that's kind of like the basic thing, right? The second thing is that you have to also, in the case of Uniswap, the way it works is like people pool the assets to create this liquidity, and every time there is a trade, everybody trades, right? Everybody has pool assets, changes their composition. So this is like this micro securities transactions all happening at the same time, because it's not that you're trading against another person peer-to-peer, you're trading against a pool, and the entire pool composition changes. So you have to actually track the new composition of the pool, because you have to update let's say the cap table. And we've done that, and it actually works very well, and it's very easy because
Wow.
it's all on the blockchain. But then there's like micro transactions happening. So the main question that we have now, and the only reason why we actually haven't moved forward with this, is that, well, if these are like many micro transactions happening, possibly you need some sort of like broker dealer or ATS providing coverage for those transactions happening there, right? Because my good friend Luis Cohen from DLX, I'm going to give him a shout here, because he's been enlightening us with this space and trying to help us navigate the regulatory issues here. And he explained to me, which I'm not a lawyer, even though unfortunately I've got to learn a lot about regulation the last few years, but I'm not a lawyer by training. And the way he explained to me was very, very good. So if you and I, John, want to trade a security, let's say you have shares on Avalanche, or I have shares in Securitize, and I want to sell them to you, or you want to sell them to me, that's a private transaction, right? So as far as it gets recorded by whoever controls the cap table, whether it's a law firm, if you do a transfer agent or a transfer agent, this is a private transaction between you and I that is completely legal, right? Nobody prohibits. It's my asset and it's your money. We trade it, and that's it. And as far as somebody verifies that this transaction is let's say compliant, we can do it. Now, if you have, let's say, 100 shares of Securitize, and you go to a bar and you put them on a table and say, like, please guys, go and trade against my 100 shares, and one buys one and the other buys two, and then the other one puts another one, and then you're becoming a broker dealer somehow, right? So I think that's the main difference. Like this way that these automated market making protocols are kind of allowing people to trade simultaneously, many people against each other, and then they're kind of somehow becoming marketplaces or broker dealers.
Like you said, if you go to a bar and we just trade one-to-one, that's fine. That's peer-to-peer. But if somehow we are at a bar and we meet 5-7 different people and we're trading with 5-7 people, you're in theory a broker dealer. And that is, it's going to be a complicated thing to solve or to figure out, because at least in the DeFi world now, the thought is, well, it is decentralized. I created maybe the software, but I'm not running it. I'm not operating it. It's these people out there who are running nodes and doing things on their own. So I just kind of put it out there. So who do you
Yes,
go
but the
after?
software is not the problem. So that's a very good observation. The software is not the problem. The problem is the whole. Suppose you do a Uniswap pool with security tokens. The person depositing the tokens that represent securities is the one that allows those securities that are owned by them to trade with other investors. And that person is the one that has the risk of actually acting as a broker dealer. It's not the decentralized pool or anything like that. So since it seems we're getting to the end of the podcast, let me now ask you a question. It's like as I mentioned to you, we have this great partnership with your company. We're very excited about a blockchain that scales at a low cost. But what are the plans? What is on the roadmap for you guys? That we're going to be seeing in the next 6 to 12 months.
So what we're most excited about is partnerships like with you guys. So we are actively populating our ecosystem, if you will. Recently, there's this thing called Pangolin, which is like a Uniswap clone. And within a few days and weeks, we suddenly have had hundreds of millions of dollars transacting on it, and hundreds of millions of dollars locked in that Uniswap type clone, if you will. The interest in that has been fantastic, and primarily because people like to see the speed and at the lower cost that you've talked about. But what we're looking forward going forward is populating this whole ecosystem with similar things that we see on Ethereum. And we don't really think of ourselves as Ethereum killers. We think of ourselves as complements to Ethereum. Like, go do your thing there. We have our community has actually created a bridge that allows people to bring assets back and forth easily. And then after the ecosystem is better populated, which is happening very quickly every single day, what's even more exciting, I think, is working with guys like you and being able to do it in a way that's regulatory compliant. Our technology was built with the eye towards how do we digitize and allow the $360 trillion of traditional assets that sit on balance sheets of banks around the world and funds around the world how do we digitize a big proportion of that in a regulatory compliant way and allow them to govern it? So our permissionless blockchain we talked about in terms of the bridge and the things that's happening with the hundreds of millions of dollars in Pangolin, but we have a thing called subnets, which is basically allows an institution or or a fund to actually spin up a, call it a private blockchain, if you will, where they can dictate who runs and validators of the nodes. So they can actually create the laws or the rules of governance and enforcement themselves in this private blockchain environment. And that's actually important for a lot of institutions and for a lot of funds, because as you talked about earlier, Carlos, the restrictions or the regulations in different geographies are so vast. And then sometimes there's subjectivity involved in terms of what you are willing to do and what you're not willing to do. So if you let Bank XYZ, who has a different view and a different type of security than Bank ABC, run their own private blockchain, but allow them to take the restrictions, not just on the smart contract layer, but on the network layer, and let them create the rules for the validator set and let them invite who their validators are so they can all share in the governance. That's like a solution that allows people to say, okay, now I can go and try to digitize things in a compliant way. And we're seeing that. We're working with a large asset management firm in Switzerland. It's early, but they want to raise a real estate fund and they want to put it all on a blockchain. And part of the reason is because they think if you have all the LPs in the same blockchain, it's different rules, whether allowing them to trade LP units with each other than opening it up to everyone else. And if they ever wanted to like create a pool, two pools, one for real estate and one for, call it technology type asset management product or a fund, they can actually connect the two pools together if the LPs are in both areas and allow those LPs that fit in the middle of those two different circles to trade with each other as well. So, and besides the cost savings that they would have in putting all the administrators, the accounting stuff, as well as the LPs into a blockchain ledger as opposed to a traditional stack of technology. So we're really excited at someday going out of just a permissionless world, working with partners who know the rules and to create and digitize the 360 trillion of assets, not just the 40 or 50 billion that's trapped in the DeFi world.
Well, I look forward to this, at least 1 trillion of those with you guys. That will be plenty for us to do. And this is very exciting. We're really excited about working with you guys and the future plans. We share the same vision, right? Like, you know, every industry has been digitized. It's time for finance to be digitized as well, right? And blockchain is the perfect platform to do so and represent ownership and create financial service applications. So let's do it.
Absolutely. But I think there's a reason why finance and healthcare have been the last two industries where, you know, technology has disintermediated. That is because it's so heavily regulated. And without companies like yours, it's almost impossible, who've been, you know, thinking through how to do it in a right way and attaining the right licenses. So again, kudos to you guys for, you know, really having the patience and doing things in a right manner.
You're absolutely right. Everybody, you know, I used to work at a large corporation and we had a lot of consultants coming and presenting things to us. And they had this slide saying, every new invention has been adopted at 2x the speed of the previous one. And they have like the newspaper and then the TV and then, or the radio and then the TV and then the internet and the mobile phone. And you know, they don't realize that none of those things are regulated. So that's why they got adopted so fast. Finance is a different story. It's not going to go that fast because it's highly regulated. It's going to take longer. And I think, you know, the companies that manage to stay in business and do things and have the patience and the persistence to be in business until this thing happens are the ones that will succeed.
That's right. Well, thank you very much. And I enjoyed this conversation. And I did talk about how we're excited about this very long future, but I think people who listen to this have to realize that there is actually some short-term things that we're working on together that they should watch out for. That is also super exciting.
Most definitely. Thanks again for doing this, and you know, look forward to continue working together.
Likewise. Take care.
Thank you. Bye bye.